Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with Anthony Faso. We just finished recording our top 14 frequently asked questions.
Perfect. Yeah. And so here's a couple. One is, why isn't everybody doing this? And we also answer, can I roll my 401k into a policy?
Absolutely. And the third one of many is, won't I get killed by the agent's commissions? That's a good one. We get that one a lot. But also, if you have any questions just on whether infinite banking is a good fit for you, make sure you hit the show notes. There's a link in there to schedule a 15-minute phone call to see if it's a good option for you or not.
Enjoy the episode.
Take care. All right, Anthony. We are going to dive into the top 10-ish questions that we get asked most often. We've really got 14 questions that we're going to address here. And some of them we've already answered in previous podcasts, but we want to include them because they are very important. But let's get started.
Well, let's get started with one of my favorite questions, and that is, but I can get a higher rate of return.
That is one of my favorite questions as well, is because we hope that somebody that we work with can get a higher rate of return. And so what I would say to this is when people propose that question to me is, again, we did a podcast on this, on the difference between saving and investing. On a monthly basis, what we want to do is we want to get in the habit of the act of saving, right? Putting money away systematically, and that's putting money into the policy. Investing is very different. Investing takes some due diligence, right, before we move into those types of opportunities. And so the only time that we should be investing is we've gone through that process and there is a very high expectation on a return of principal and an increase or a rate of return on that investment. And so that's what I say to people is whole life insurance, right? The way that we're setting up is going to be a cash management system, and that's where you put your cash in between investment opportunities.
I like to say that infinite banking is not an either or. We're not saying put your money in life insurance or real estate or your business or whatever the investment it is, that this is an and asset.
Yep.
That you can put the money in the policy and invest in real estate and invest in your business. And one of our podcasts we did a couple weeks ago dove deeper into that, and I think we also included a video.
We did.
As well. And the whole point is the real power of the real returns are going to be from having some money safe and liquid available for opportunities, and then your policy can help you get there.
Yep. Awesome. Thanks for adding that on there, Anthony. And I'm going to propose question number 2 to you, which is, why isn't everybody doing this?
What I would say, everybody who's done proper research is.
Good question.
I would say. But also, there are limits to we are restricted on advertising in there, and also I think typical financial advisors don't want to do this. They want to accumulate the assets under management, and this is the exact opposite. And one thing that I found, I know one of, just a little prelude to one of our other questions when it talks about commissions. Right? A lot of people say, well, they're just selling you a whole life because so they can make a lot of commissions. But the exact opposite is true. The way that we design these, I don't want to answer that question right now.
Well, you can knock off 2 of them. Go for it.
Okay.
Yeah.
Well, I mean, one question people get is, well, because I remember when I first read the book, I was like, this was one of my questions. Why isn't everybody doing this? This is too good to be true.
Mine too. That's literally the same question I had.
But I had mine a little bit before.
No, mine was word for word, and it was about a month before you.
And I went to other financial advisors, right? And asking them all sorts of questions. And one of them was, well, they're just selling you that because you can get a large commission. Mm-hmm. But the way a properly IBC policy is designed, we actually take a huge cut in commissions. Like if you were to go down the street to say one of the name brand insurance companies, say, hey, I want a whole life policy. And let's just say your premium's $20,000.
Yeah.
Right? Premium's $20,000, you're going to have a lot of death benefit. But you know what you're not going to have?
Cash value.
Cash value until about maybe year 3 or 4. The way we design it, same premium, right? Your death benefit is going to be much smaller, but you're going to have cash value immediately. And that's because that's how we need to design it to properly have it for infinite banking. But what that does do, to be frank, with our commissions, we're getting about that other individual is getting about 2.5 times more in commissions than we are. So what is funny, sometimes we'll go to one of these industry events and says, well, how do you get so much life insurance? And then when we explain it to them, oh, well, instead of us getting paid on the 20, we're going to be getting paid maybe on $6,000. And they're like,
yeah,
I'm not going to do it. You know, They are missing the big picture.
Totally agree.
Okay.
Yeah, with everything you said, surprisingly. Question number 3.
Well, since I took 2, I'm going to give you this one.
Okay.
Why do I have to pay interest to borrow my own money?
Ooh, that is a really good question, and we could literally do an entire podcast on that. Yeah.
Might be a good idea.
Yeah, good idea, right? Is the way that I answer that one is, once you understand kind of how this whole thing works, how whole life insurance works, a lot of people kind of think it's a black box. It's kind of this crazy idea here. But once you kind of peel back the layers and you understand what's happening inside the insurance policy, it's pretty straightforward. What you're going to do is you're going to pay premiums to the insurance company, like Anthony just mentioned, and you're going to build up cash value. And as you build up cash value, you can always access that cash value in one of 2 ways, through a surrender or through a loan. When you surrender it, essentially you're just saying, give me my money back. I have no intentions of ever paying this back. On the other hand, with the loan is you can put your money up as collateral, right? And this is where the interest piece comes in at, is you're actually not accessing the money from your policy, is the insurance company is going to send you dollars from the general fund of the insurance company. So to put some numbers to it, if I've got $100,000 of cash value and I want $25,000, I say, hey, give me a loan of $25,000 against my cash value. I'm putting the $25,000 in my policy up as collateral, and they're going to send me $25,000 from the general fund of the insurance company, and now there's a lien against the money in my policy. Right? So if you understand that there's 2 separate actions or transactions that's happening here, then you understand what's really happening inside this scenario. And there's always this progression of understanding, I guess, that kind of takes place. Is the first time that people look at this, first several times that people look at this, they think, man, why would I ever want to pay interest? But if you understand that your money is sitting there earning and compounding every single day, every single year for you at that 3 to 5, let's call it 4%, then you start to understand that, man, this is a very small detail in the big picture of infinite banking, but it has huge returns, is because our money is sitting inside that policy, continuing to earn, continuing to compound year in and year out. And so that's a small detail, but it has significant returns for us. Anything else you'd like to add?
Well, when somebody asks me, why should I pay interest to borrow my own money? And I say, you're not. Because you're not borrowing your money, you're using the insurance company. And that's why, and what's happening to your money, it's still sitting there continuing to compound.
I'm going to jump in there, and I'm going to say this, is I think that part of the problem with that question is I'm going to place the blame on our industry, is because I think that it's communicated to clients improperly, and in general, right? As I think advisors don't communicate appropriately, right? We are very specific, and now, as I mentioned this, you're going to hear it moving forward, is we always say that you're going to take a loan against your cash value. And a lot of times people will say, I want a loan from my cash value, right? It's minor wording, but it means a big difference. And so that piece right there just means that somebody has a lack of understanding on the collateralization of their cash value.
Wow, that sounded good.
Well,
yeah, nice.
Yeah. All right, moving on. Number 4, Anthony.
Yes.
Perfect question for you. Can I roll my 401k into this?
Interesting question. Technically, the answer is no. you cannot roll the money into, like a lot of times people think about rolling a 401k from one account to another, or you're really doing it from one custodian to another custodian, say from Charles Schwab to Fidelity, but it's still inside your IRA or 401k. Now, those are government plans, so there's restrictions on how you can move money in and out. So, believe we have clients that are using those proceeds from their 401k or IRA. However, we need to get it out of the IRA and 401k. Thus, if there's any taxes or penalties due, they do need to be paid. I will say, for me, when I first started, I wanted a jump start, and really, unfortunately, I had most of my wealth. It was in my house and in my IRA and 401k. So to get those out, I actually chose to take the money out of my 401k and IRA, pay the penalty in tax. Now, while I felt the taxes are low, so that they can be in a tax-free environment, and now instead of being told what I can invest in, really mainly mutual funds, now I'm able to invest into anything that I do want. And we have some videos, and I think we did a podcast on it in regards to the CARES Act. If you ever wanted to take money out of your IRA or 401k, it has literally never been easier. So if that's something you're interested in, I would go back either on YouTube. We have we will put the links in the show notes.
Great. Question number 5. Does the insurance company steal my death benefit when I die?
I tell you, I always chuckle when I hear this.
Okay,
right?
Grandpa.
Because I mean, the insurance company isn't stealing anything.
Yeah.
Right? I mean, particularly companies we use, they're mutual companies, so mean that they're owned mutually by the policyholders. They are on our team. This isn't the evil insurance company like you might think of with auto insurance or maybe your health insurance.
Yeah.
Right? These life insurance companies are on your team. You are the owner. And if we kind of pull back to get some of the big picture, the way the policy is designed is that the death benefit is going to meet the cash value at maturity. And that for a while there, that was year 100, and now it's going to year 121. If you look at a policy at that maturity date, the cash value equals the death benefit. So those two are going to equal. And the insurance company isn't going to steal anything. Where this is coming from, well, for one, it's coming from typical financial advisors.
Yep.
Because I know Dave Ramsey has made some comments about this. And this is where this misinformation is coming from. Okay? Let's say you had this policy for 5 years. And I'm just pulling these numbers out for illustrative purposes. Let's say that the death benefit is 1.4 million. Okay, the cash value is 300,000. Mm-hmm. You're going to get 1.4 million. You're always going to get the death benefit. Of course, if there's any loans outstanding, those will be paid off. But this person is going to get 1.4. They're not going to get 1.4 plus the 300,000, which is what some of these people are trying to punch holes in whole life. Okay, but you really need to look back at the big picture. In year 1, what was the death benefit? In this example, the death benefit is probably going to be around $1 million. So year 1, it's $1 million, and in year 5, the cash value is 300,000. So if you got both, you get 1.4 million. Okay, but inside these policies, the cash value is growing, and the death benefit is growing. So would you rather, you can have the cash value and the death benefit, which would be 1.3, or, you could have the initial death benefit of $1 million plus the current cash value of 300. You can get 1.3 million, or you could get the current death benefit, which is typically going to be higher. In this example, it's 1.4. So Cameron, would you rather have 1.3, have your cash value and the death benefit, or have 1.4 where the evil insurance company steals your cash value?
I'll take the 1.4.
Okay, perfect. Good man.
Yeah.
We also created a video on this where we have a sample illustration and we kind of walk you through it. So we'll put that in the show notes as well.
I liked what you said there. I was just going to repeat it. You'd said that you're always going to get the 1.4. And in that scenario, you'd said 1.4 and then you got 300,000 in cash value. If there is a loan outstanding, which means that somebody borrowed against their cash value, is they already got the 300,000.
Mm-hmm.
From the total of 1.4, right? So you could look at that 300,000 of cash value as an advancement of the death benefit. So you got your 300,000 to go buy houses or whatever you wanted to do with it, but then you also got the remaining 1.1 in the form of a death benefit when you passed. So
great.
I just had to clarify, clean up what you said.
Okay, next one. How much of my cash value can I borrow, and how quickly?
Ooh. Great questions. I get this all the time. So when you're talking about how quickly, usually it's when somebody is first initiating or starting a policy, is they say, how quickly can I get my cash value back? What I usually tell somebody is, hey, when we're starting the policy is let's write that first month's premium, or let's send them the amount of money for the PUA rider to fully fund that, and let's let it sit there for 30 days, right? Let's give the insurance company a grace period, just let them get it processed and go from there. But there's always an exception. Right? I've had clients where if you send them a check on a Monday and then Friday they come back to me and they say, hey, I need the money, right? We've actually got money turned around inside of a week in that case and got it back to them. There's some hoops we got to go through. We just got to prove that the money's been drafted from their account. But outside of that first initial meeting, first initial setup of the policy it's pretty quickly. After that is when somebody comes in and they want a loan, and let's say the policy's been in place for 2 years and they want a loan, is you can get the money actually next day to you for a small fee. I think it's $11 or $14, but you can get that money deposited into your account for a small fee the next day. If you just send the request in the insurance company, you say, hey, I need X amount of dollars at your convenience, it usually takes 3 to 5 business days. Right? So that's kind of the timeline. So when somebody calls and asks, I'll say, hey, what timeline are we working off of? It needs to be urgent. Then we move it to the top and walk them through those options. How much of my cash value can I borrow is typically the maximum amount most insurance companies will allow you to access is going to be about 95% of the cash value that's in there. And so there's always going to be about 5% that's remaining that they're going to hold on to. And typically that works out to be about the first year, 1 year's interest on the amount of money that's in there. We have some recommendations as far as how low you should normally take that and how much in reserves you should have. But the maximum amount that you can access is going to be about 95%.
So why don't you expand on it? What do you recommend keeping inside the policy?
The very minimum that I would recommend keeping inside the policy is at least 1 year's annual premium inside of there. And the reason that I say that most of the time is because I want to make sure that we've got enough money to pay that following year's premium. And so what we'll do is that's called an APL, an automatic premium loan option, where somebody can come in, access as much money as they want to. We've got 1 year's premium that's in there. When that premium comes due, we can use that cash value to pay that premium for the year, and it's paid up, and we're good to go.
Now, you said 1 year's premium. Are you including base and PUA or just?
Man, you're really splitting hairs here, but it's a really good question.
It's a big difference.
It is right? A big difference. I would like to see base and PUA, but at the bare minimum, we want to make sure that we have the base premium amount taken in there for 1 year.
And that's exactly what I tell them, because life happens.
You got that from me.
No, I didn't. Life happens.
It
right?
does, yeah.
And I've seen it early on where people are, I love this, and they're paying their premiums, borrowing all the money out, and putting their money to work, which is great. Which that works until all of a sudden it doesn't.
Yeah. Then
it's time to make that premium, and some deal just didn't get funded, or something happened, and now we're trying to make sure that these premiums are paid. And what I also like to add, we need to have some liquidity. We can't use all of our funds. We need to have what you call it, an emergency fund, whether you want 6 months or 1 month or a year, or I like to have an opportunity fund. So I recommend that we need to have some money liquid. Life is going to happen, and also so are opportunities. And we need to have liquidity to take advantage of those opportunities.
So we work mostly with kind of business owners, entrepreneurs, right, or investors. And one thing that I will always tell people is, man, we are entrepreneurs ourselves. We're business owners. And I'll tell you about my situation is that, man, my checking account or banking account doesn't always coincide with premium notices. Right. Right. So sometimes I may not be flushed with cash when a premium notice shows up. And so I rely on that APL option inside of my policy to pay for that premium. And then the next month, right, all the money comes in, and now I'm able to just go back and fill it up. And so the first couple times that this happens is sometimes, clients will call and, there's sometimes a sense of guilt, like, oh man, you know what? I can't pay this. What do I do? So we'll kind of walk them through that option and just let them know, hey, listen, we're all entrepreneurs, right? If we don't pay it this month, we pay it next month. And the last thing I'll say on that APL option is that is a short-term solution, right? So that's never a long-term solution. The idea of using that APL feature is really just get you through the premium notice and then pay it back as soon as we can.
Perfect.
Thanks. All right, moving on. What do we got? We got number 7. Oh, that's a good one. Can I or should I have more than one policy?
Well, can I or should? Question is obviously yes.
Okay.
Right?
And could you expand on that?
Yeah. And I would say for most people, I'd recommend that you have at least 2 policies. Where we have a whole life policy, that's where we keep our cash value. But I also like to have some term insurance. And we're not building equity in there, but I like term insurance for 2 reasons. For one, the most important one is we want to make sure that we're protecting the family in case something happens. Okay? And 2, when you have term insurance, you can convert that, meaning turning that into whole life without being examined again. And I will tell you, 2 years ago when I got was getting some new policies, I was like, you know what? Kind of not digging getting underwritten every other year or so.
It's because you're getting old.
Yeah, and I'm getting older, and I'm not getting healthier. So I went ahead and I got the max term insurance. In part, it was more than I really needed, but that comfort to knowing I'm not going to have to get examined again was pretty nice. But I think a lot of people this question comes from is they're not aware that if they're allowed to have more than one, right? This is not a government plan. So this is a private contract between you and the insurance company. And most of our clients, I tell you, when I first started IBC, it's like, this is way too good to be true. Let me put my toe in the water.
Yep.
And I got a small policy. And then I'm like, okay, then I took some of that. I took a loan and I paid off my car. Instead of paying Ford Credit, I started paying the Faso Family Bank. I was like, man, this is pretty cool. So then I got more comfortable, and then I got another one. So I will say one question we get is, should I get 4 policies or 1? Right?
Yeah.
What do you say to that?
There's pros and cons to both of them. I've got multiple policies, but what I usually say is it doesn't matter from the insurance company's point of view if you have a total of $1 million of death benefit in force. They don't care if it's 1 policy or if it's 4. So if that's your maximum amount of insurability, it really doesn't matter from their point of view. But it does matter. What you just talked about was having a whole life policy and a term policy. There are advantages that I see to having maybe 4 whole life policies of equal amounts that equal $1 million of death benefit. And some of those advantages are you can go to both extremes. Number one is, hey, let's say our cash flow or years get tight and lean, where if I've got $1 million policy and I'm not able to pay that premium, is man, lapsing that policy may end up being an option for me, right? But if I've got 4 of them at a quarter of that premium amount, man, maybe I'm able to manage those a little bit better, right? And I don't have to lose all of them, maybe just one. And then you can go to the other extreme on the other side is, man, if I've got, 4 policies at $25,000 premium a year, could I not utilize that APL option again, right, to kind of get through use the same $25,000 to pay 4 policy premiums and then fill it up later, right? So I don't know if I exactly answered your question on that, but for me, I would rather have several kind of smaller policies than one big one. Yeah.
No, yeah. That was good.
Thank you.
You were
Thank
going a little different than I was looking for, which is okay. But I you brought up surprisingly a very good point, right? Where I think a lot of people is like they can only get one, and then if they wait a couple years later, they can't get another one.
Yeah.
And the insurance company doesn't care. There's a certain maximum that a coverage that they will allow, but that number is typically a multiple of your income. So a lot of times that number is going to be pretty high. So rarely do we bump into the limits by the insurance company. But I will say, look, I don't even know how many policies that I have now. I will say, looking back, I mean, it would have been more advantageous for me to have one big one from day one as opposed to getting these other ones in the future. And the main reason being is just compounding. If I could have had those bigger policies at the beginning, I would have started compounding sooner. But to be honest, we also have to go with when people are ready. At that point, I wasn't ready for a big policy. I needed to put my toe in the water.
Yeah. Same here. As I started off with 2 policies, one me, one on Jess, and then just kind of built from there. And I'm pretty sure I got one more than you.
Okay. Well, let me let Becky know I need to convert some term. Our podcast ended up being a little bit longer than we had planned, so Cameron and I decided to break it into 2 parts. Now, we will have the second part in a couple weeks where we will go over, is life insurance FDI insured? When can I take my first policy loan? And am I too old? Just to name a few. Go make it a fantastic day.